Good evening. Welcome to Foreign Affairs Live, the series that brings articles and issues in the pages of Foreign Affairs magazine to life. With you, our readers, so many of whom grapple with the issues in the pages of the magazine in your professional lives and your intellectual lives every day. This week, Foreign Affairs released a fascinating article, The Innovative Finance Revolution. The piece shines light on cutting-edge financial products designed to generate profits while also funding solutions for public crises in health, poverty, natural disasters. You will hear tonight from an impressive panel of speakers bringing public and private sector perspectives on this exciting field, including one of the article's co-authors. A few housekeeping items before we get started. Please silence your phones. If you're on Twitter, please join the conversation at #FALive. When you're asking a question, please, there's a lot of smart people here tonight. We want to make the most of the question and answer session, so please actually ask a question concisely. Thank you. On behalf of all of Foreign Affairs, I would like to thank the Rockefeller Foundation for being such wonderful partners on collaborating on this event. Without further ado, I introduce Peter Blair Henry, author, economist, currently dean of NYU's Stern School of Business, to help frame our evening's program. Enjoy, and see you afterwards at the reception.
Thank you, Linda, and good evening and welcome. Almost a decade after the global financial crisis, the world economy remains mired in a state of slow and declining growth with challenges from many sides. Diminished optimism about the future has reduced household consumption. Businesses are reluctant to increase spending on plants and equipment. Declining capital flows to emerging markets are at odds with the need for job creation in systemically important countries facing a boom in their working age populations. Technological advances continue to disrupt industries and boost the need for high-skilled workers at a time when access to education is too often in doubt. And the absence of political commitment to important structural reforms in both advanced and emerging economies have eroded expectations about future productivity, further dampening growth today. As many observers of the global economy have noted, investment in infrastructure, from airports in the United States to power plants in Nigeria, could help with all of these challenges by raising productivity, prospective returns on a variety of capital investments, and expected future growth. Indeed, the estimated requirement for global infrastructure investment is about $4 trillion a year in comparison to the $3 trillion per annum that is actually taking place. There are many obstacles to bridging this trillion-dollar gap. Many of the infrastructure projects with the greatest potential to contribute to economic growth are located in emerging and developing economies with levels of risk, sovereign risk, exchange rate risk, et cetera, that result in these projects being too costly to finance in spite of their high expected rates of return. And this is just the infrastructure funding gap. The gap between overall societal spending and need is even larger. Achieving sustainable development goals will cost an estimated $5 to $7 trillion a year, with an estimated funding gap of $2.5 trillion annually needed to fund efforts in developing countries alone. Certain societal challenges, such as global climate change, are continuing to escalate, as are the costs. The earlier the world invests in prevention, the less money will ultimately be needed to combat these problems. Quite often, the money that does arrive is too little, too late, primarily from governments and nonprofit organizations. Meanwhile, assets held by investors top $200 trillion globally. Might there be a solution here? Innovative finance. As Dean of the Stern School of Business at NYU, I'm often asked to describe our mission, which is to develop people and ideas that transform the challenges of the 21st century into opportunities to create value for business and society. So you can imagine how eager I am to hear from our panel tonight. Innovative finance represents a set of financial solutions that have the potential to transform a 21st century problem into an opportunity to create value, and not just for business, also for society. Innovative finance has the potential to create scalable and effective ways of channeling private money towards social, economic, and environmental problems. Innovative finance can lead to cost-effective international aid, can generate profits, and let investors diversify their holdings. The private sector has already seen success with innovative finance solutions, such as sovereign pooled risk insurance against natural disasters, green bonds, 40 billion of which were issued in 2014, and another estimated 80 billion in 2015, as well as catastrophe bonds. The Rockefeller Foundation, through its Zero Gap portfolio, is working at the intersection of international finance and development to de-risk innovative finance solutions. Zero Gap aims to close the massive funding gap between the money we need to address pressing global problems and the money currently available. It's helping to shape the next generation of innovative financing solutions through funding as they are tested in their early stages of innovation. These are solutions that have the potential to unleash private capital at a scale that can help solve global problems. A number of things are needed to help the field grow even further. The developers of innovative financial products must continue to provide attractive yields and further mitigate the risks, real or merely perceived, posed to investors. Investors also need reliable data to ensure them that innovative finance will help them do well while doing good. Here, technological innovation is complementing financial innovation. Government policy needs to shift in ways that will encourage more innovative finance, in part by changing budgeting processes to allow for strategic commitments to long-term investment in social and economic development at home and abroad. So if you'd allow me one last time to wear my hat as Dean of a business school, I'd like to wrap up by sharing the central thought behind our mission at Stern, that business can be one of the strongest forces for good in the world. We reject the notion that business success boils down to a set of compromises through which we must advance either profit or principle. We call this embracing the and. Now, I look forward to hearing from this distinguished panel about how innovation in finance can deliver returns and help to solve some of the world's most pressing problems. Enjoy the evening. Over to you, Alan.
Thank you. Thank you, Peter, for getting us started, and thank you all for coming. It's great to see such a big turnout at cocktail hour for this topic. My name is Alan Murray. I'm the editor of Fortune, and we have a great panel here to discuss this, a diverse set of experiences. You have their bios, I believe, in the information, but let me quickly introduce them. Kyung-Ah Park, who is with Goldman Sachs, and then Kenneth with the Rock Creek Group, Saadia Madsbjerg, who is the co-author of the piece in Foreign Affairs and is with the Rockefeller Foundation, and Christopher Egerton-Warburton. It's a lot of names for me to have to remember, Christopher. We're going to call him Edge from now on, just to keep it simple. And Christopher is with Lion's Head. And what I'd like to do to get us started is, I think Peter gave us the big picture. I'd like to go right away into specifics and get each of you to give the best example you've seen of innovative financing to address social goals. And Edge, I'll start with you.
Oh, that's tough. I mean, I think that the truth here is, I think innovative finance is about solving problems. And so the best, it's not right to sort of say, well, is this model right, or is that model right, or is the other model right? It's more about saying, what is the problem, and how can we work to get capital to come together to solve that problem? And so, I was faced with that in a number of situations as covering governments in the capital markets desk at Goldman, and And we rose to the challenge when we were set a problem and people said, how do you solve it? And so, I mean, I guess the reason I'm here is because of my involvement with IFIM when I was at Goldman, which was exactly that. The governments were looking to say, we want to meet the Millennium Development Goals. In those days, the budget that Zedillo put on the Millennium Development Goals was $400 billion, an additional $400 billion. And the Chancellor of the Exchequer at the time, Gordon Brown, came to New York and spoke at the New York Fed just after 9/11, which was probably quite a raw time to be here in November 2001. And he made the point of saying, despite everything which is going on, the MDGs have just been signed and they're important. And would it be possible to take the cash flow that we plan on spending from 2015 onwards and front load it into the period pre-2015 and meet the MDGs, and then there are going to be great things that come from meeting the MDGs, and we'll have less money to spend in the future. Now, as we just heard, the current budget for meeting the SDGs is a couple of $1 trillion. So I think I did the wrong thing, right? We managed to inflate but I think the fact of the matter was that actually that process, I think the MDGs were fundamental in getting people to.
So what did you do to meet that goal?
So we created a vehicle to help fund immunization. It's called the International Finance Facility for Immunization, or IFIM, which funded a pioneering group at the time, Gavi, had been pulled together by the Gates Foundation and others to basically solve the equity gap in vaccination globally. Fundamentally.
And what was the instrument?
So the instrument was to say exactly the answer to that sort of Rumpelstiltskin type challenge from the governments. We took 20-year and 30-year, in some cases, government cash flows, managed to pull that cash forward, get it struck into a legally binding, predictable format that didn't overburden the government budgets, and then have a way where effectively Gavi could have a credit card where, as it needed to spend that money, it could front load that. And we used the World Bank and Ken and his colleagues as the treasury manager. Gavi is the program manager. They're spending the money. And the trick was to try and create something that could raise money at costs, obviously as close to government yields as possible.
How close did you get? We're going to move on. I don't mean to put you on the spot here. We just want to get through the example and we'll move on.
No, well, we basically funded 10 basis points wide of the World Bank, which I think for...
So it's a pretty big success.
That's a big.
You got a AAA credit rating.
It got a AAA credit rating. I mean, the only thing I'd say is that in order to do that, effectively, we created an emerging market structured CDO. That wasn't what we called it. We wrapped it with we called it a multilateral development organization. And I take a little bit of pride in the fact that but in truth, it is, underneath all that, it is an emerging market CDO, and it sailed through the financial crisis and everything else, and is still issuing bonds today.
Saadia, at Rockefeller, you see a lot of, you've been involved in a lot of different projects, but what one would you pick out as kind of a shining example of innovation in finance helping to drive social goals?
So I think it's a hard question because all of them are close to my heart, but the one that I would like to talk about is disaster risk insurance. So one of the things, and it's also covered in the article, is African Risk Capacity. It's a specialized agency of the African Union that was set up to help African countries manage the costs and the effects of natural disasters. So, many of us, don't naturally know this, but Africa as a continent is very predisposed to natural disasters. Droughts is one of them. And the way the system usually works is a disaster happens, then the UN agencies and a lot of other NGOs go out and make a humanitarian appeal that says, this is what has happened in this country, this is the money needed. From the time the appeal is made till the time the money is made available, the situation actually gets much, much worse on the ground. And it's a cycle that repeats itself year after year after year. What the governments in Africa need is some predictable way of accessing money at the right time so that they can deploy it towards the places where it's needed the most. And that was the challenge that led to the creation of African risk capacity, and related to it, and that's the mechanism, which is a pooled risk insurance. So they created an insurance company. The African countries went in and took out, the very first pool was around drought insurance. And there were 4 of the countries that took out drought insurance. And it's like a 1-year pool. And in 2015, when the drought hit Sahel, before there was even a humanitarian appeal made, 3 of the countries had the money available in their accounts so that they could go on the ground and undertake the interventions that they needed to. In certain cases, it was cash transfer programs, so they could make cash directly available to the people that were affected by it. In certain cases, it was subsidizing the cost of fodder, because a lot of the people have their livelihoods attached to cattle, and you need to make sure that they.
But it was a straight insurance program. They
it was
paid
a straight
premiums.
insurance program.
Why hadn't it happened before?
Because nobody had set it up before. And there were a lot of people that needed to come together for it to happen. It wasn't just a matter of the African countries saying, well, now we're going to do it, and the African Union saying we're going to do it. You had to, in this case, you had the Rockefeller Foundation that gave the very first grant that even made it possible to have an assessment of what are those countries exposed to in terms of risks and costs. And then you had the development aid agencies, DFID, and then the German one that helped capitalize the insurance company so you could even set it up. And then you have African risk capacity that worked with the governments to go in and say, here's what the preparedness plan is. If this event happens, what would you do with the money? Because
so you funded the studies and helped convene the groups to set it up, but it was not a subsidized risk pool?
No.
Yeah, it was.
It's not. And then you have the reinsurance market that has gone into it. So a lot of the reinsurance companies, Swiss Re, Munich Re, are part of that pool as well.
And we should, just to take a step back, I mean, the real reason we're talking about this is because we know that solutions that pay for themselves are sustainable, and those that don't aren't. I mean, has this sustained itself?
So far, yes, it has. From the very first risk pool, where there were 4 countries that had signed up, the latest risk pool that just closed has 10 countries signed up now. So far, it is drought insurance that's being offered, but it's going to get extended to tropical cyclones and flooding as well. And then African Risk Capacity is also working on a pandemic insurance product, which is something that was highlighted post the Ebola crisis and the lack of funding that was available back then.
Ken.
Okay, I'm going to reveal my age here, okay? I think the most creative, innovative finance that we've seen in the past 100 years is the capital structure of IBRD, which was the original institution in the World Bank. And there, just to put this in some quick perspective, my country, the United States, has put $2 billion into IBRD since 1947. The entity has had a AAA credit rating since 1959. It's gone through 4 or 5 emerging market debt crises with that credit rating intact. And it has generated, together, it and the other institutions modeled after it have generated, I don't know, a couple of $1 trillion probably in development finance over that period of time. It is just about the most efficient use of what we have a limited supply of, which is public credit, that you can think of, and it's done what we all talk about trying to do today, which is to access the global savings pool. 200 trillion is about right. It has accessed it on extremely attractive terms in what is the lowest cost part of investors' asset allocations. And
so then, Ken, why are we here? Like, what's
very good?
What's new under the sun? Why do we, if the World Bank solved this problem decades ago, why are we talking about it?
Because of course, like every other public institution, very frequently these things can get themselves tied up in knots. And you can argue, in fact, a Republican friend of mine understood exactly this point about the efficiency and said, look, why don't we quintuple the capital? Where can I buy more shares of this? But I think the point I'm getting at here is that the business model itself is adaptable. And I think a lot of characteristics of IFM that Edge has talked about there are characteristics that are common to these things, which is that it's an international cooperative, which I think is a very important point. So I make the point that it's a very
But
efficient.
proliferation is a good thing. In other words, why have multiple vehicles and not quadruple the capital of the World Bank?
Well, sure, and because we've also had various regional initiatives in which different institutions of this kind have been set up in different regions. There's one of them in Latin America called the Cooperación Andina de Fomento, the CAF, which has no callable capital. It has no donor country members. It's a pure cooperative. It has a AA- credit rating, which is significantly better than any one of its members, and it's operating on this same cooperative model. But I don't want to belabor the point, but I've always asked myself, where are we going to get the most efficient use of that scarce public credit resource, and at the same time get access the largest part of investors' asset allocations, which tends to be the liquid, high-grade parts of their portfolios. And this has been a quite effective.
Well, and we'll come back to that, because obviously one of the things we want to talk about tonight is
Right.
this growing? How much it's growing? How much of that total? How much money are we talking about? A couple $100 trillion. How much of that are we going to have?
The global savings pool.
The global
Sure.
savings pool is going to be available for this. But we'll come back to that in a minute. But Kyung-Ah, what's your example?
Yeah. So
I let you go last. So
Sure.
Now you really, the pressure's on to come up with a
yeah,
really
and I may
good-
take a little bit of social license and maybe pull two examples. But before I jump into that, given Goldman Sachs is a global financial institution, we're really at the crux of much of the financial innovation that was already discussed. Certainly Edge, when he was at Goldman, did IFM, and we do catastrophe bonds as well for weather events. And certainly classic kind of public-private partnerships benefit from partnerships with development finance institutions and being able to leverage that to be able to bring much needed capital for development agenda as well. But the area that I want to focus on, which is where I spend the most of the time, is around environmental markets, and in particular clean energy, because as Peter said, climate change is a very big environmental and societal issue, and energy accounts for the vast majority of our greenhouse gas emissions. And I want to mention, if I may, before I use the example, that there is ample capital out there, and in fact, investors, an increasing base of them, are looking for more socially responsible investing. And given that we've been in a very long, unprecedented, low interest rate environment, they're very hungry for yield. And that is highly conducive towards clean energy infrastructure asset, given that, for those of you who aren't familiar, once it's operational, there's no volatile fuel costs, and you typically see a long-term power purchase agreement or a lease that provides cash flow visibility. And so for a financier like us, when you actually have scale-up of these clean energy technologies, we're able to really tap into the deep and liquid public capital market, which is where the holy grail is, because that's where the scale is and that's where the mainstream investors are. And let me use two specific examples in terms of innovations that have happened over the last few years. First is something called yield vehicles, which essentially takes operating clean energy assets from the balance sheet of developers, basically aggregates them and lists them to the public equity capital markets. There are a couple of benefits coming out of that. First is you free up the balance sheet capital of the clean energy developers so they can raise additional capital and therefore invest in further development. The second benefit is for the investors, which is, again, investors are hungry for yield. And this essentially creates a new investable liquid instrument that they can actually invest in. It's also removed from the upfront development risk that typically investors don't like as much. And then they obviously are able to clip the coupon from the cash flow. For those of you who follow this market, I'll caveat that in saying there's been a lot of volatility. And part of that's been driven by the broader commodity market and the linkage to master limited partnerships. And part of that is some of the execution risk entailed. But my personal view on this is that the actual characteristics underlying yield vehicles are very much intact. A second example of innovation that is happening is securitization. Securitization is a well-known mechanism. IFM is a classic example of that. Mortgage is another example. But securitization has recently been applied into the clean energy market for smaller solar projects, as well as for energy efficiency, and even for the auto loans for clean vehicles. And the one example, if I can get specific, that I'm probably quite excited about is a partnership that we had where we served Hawaii in terms of raising what's called a green energy market securitization. What it essentially did was take a green utility fee that was put across a very broad ratepayer base. And by the way, that was actually offset by a reduction in what's called a public benefit charge that existed. So there wasn't really much additional burden on the ratepayers. But that cash flow visibility enabled us to help Hawaii raise a very low cost securitized green bond, about 150 million, that is low cost, and then enables actually access to much needed financing for the underserved markets, such as the low income segments or the renters or the nonprofits that may not have, through the normal course markets, the financing to be able to purchase solar panels or do energy efficiency measures. So another way of leveraging the capital markets to bring access to capital for the underserved
How
segments.
much money was raised?
150 million.
150 million. So, Kyung-Ah, you said something very interesting early on that I want to ask the whole group about. You said that investors want social impact. They want to make a difference. They want to make the world a better place. And they want yield. So which do they want more? Is there any willingness? I mean, this has been something that has been asked about consumers for a long time, and generally the feeling has been, yeah, sure, people will buy products that they think are good for the world, but they won't pay more for them. Are we in the same place with investors, or is there any willingness to accept increased risk or reduced yield in order to do social good? Who wants to give me the definitive answer?
Well, I've got a view. I mean, the good thing here is we all talk about these impact investors, and I love impact investors. I have yet to find someone who invests for bad. You know, you line them up, and the whole room is full of impact investors, and because the truth is, we all think that our funds will, we want good things to happen with our funds. What I think where the world has come to is that people are willing to invest in a project or a product that they may not have normally done at a yield which is comparable to what they have in the sort of the area that they feel comfortable with. And I think IFM's an example where I said that we managed to raise money at essentially the same cost of funds as the World Bank.
Is it, Kyung-Ah talked about volatility. Are they accepting more risk when they do this, or is it?
No, I mean, but normally, and in investor, who the AAA investor space actually yields are quite wide between people like the governments and people like the World Bank, who are sort of very safe, and then kind of very structured AAAs would trade a lot wider. And so people were willing to, when we went into the roadshows, okay, I was there to talk about the structure, and Ken's deputy, Doris Herrera-Pohl, was there to explain kind of all the good things which Gavi did. Trust me, there were no questions to me. Everybody wanted to talk about, right. So where's the money going? How many kids get immunized? Et cetera, et cetera. It was the story that engaged them, and I'm sure in the climate change space you have that same.
So they like the story. They want to have social impact, but they're not willing to pay for it. They're not willing to sacrifice yield or accept increased risk.
Can I jump in for a second?
Please.
So there's no one size fits all. When we talk about social responsible investing, there's a wide variation of different investors. And I think it ranges from everything from alignment and screening things out. We're seeing that with the fossil fuel divestment movement as an example, all the way through integrating environmental social governance criteria and really looking for long-term outperformance. And there's increasing empirical evidence that shows that when you integrate ESG alongside traditional ways of looking at companies, you actually can certainly think about risk mitigation, but also over time be able to identify long-term, particularly in the stock side of things, outperformance. Fixed income, I think, is
so you don't have to accept trade-offs.
But then there's a third category, which I think is what the true impact investment space is, which in an ideal world, you don't want to have concessionary investment because they're not scalable. But in the initial stages of the market, you have to prove the concept out. And that's where I think concessionary capital comes in, whether it's in the form of public-private partnerships, or patient capital, or even in the form of grants, like the Rockefeller Foundation's doing.
Yeah, go ahead.
Maybe I can just step in here, Alan, as well and say, so at the Rockefeller Foundation, what we do is we front the R&D cost for a lot of these new mechanisms. And again, the mechanisms ranging from insurance product to new investment fund structures to debt and equity mechanisms that somehow can attract capital. The way we approach it is to say we want the solutions to be sustainable so that they can stand on their own, and we want them designed in a way so that they can scale. And yes, we do it as a foundation because we want it to have impact on the social problems, the economic problems, the environmental problems. Now, but that's the basis on what we want them to stand on. If it's important to the investor that there is a social impact, then that's great, but we want them designed in a way that it speaks to whatever their risk-return expectations are as well. And I think there's a mixed bag of investors out there. I think you have investors that are willing to go in and say, yes, social impact is important, hence I will accept this trade-off. And then there are others that won't accept it. But if we want to get to a place where we can close the massive funding gap that we have across the board, these solutions need to be sustainable.
Yeah.
And they need to be done in a way where they can stand on their own, right?
Ken?
Yeah, look, I would reinforce what both of them have said. I think the good news is that a lot of these elements are becoming more quantifiable, which allows, in the traditional approach to asset allocation that a lot of investors have, and that their authorizing environments pretty much require, it's getting easier for them to integrate here. But I think in some cases they've been excruciatingly clear about this, and I think it's important to understand it, and I think it's also important to be very specific. In that $200 trillion savings pool, you have a very large proportion of that is pension funds or is insurance companies that have very specific regulations concerning their...
They're basically legally required.
Yes, and and that the legal framework is changing somewhat, everybody understands, but I think it's important to keep that in mind. And I'm mindful, and it just is a vivid example, when the Secretary General in September of 2014 came out with a statement that had been endorsed by a number of the major pension funds saying, we are prepared to consider and evaluate all climate resilient investments that fit our asset allocation protocols, are competitive with the other opportunities in the asset class, meet the other constraints in our portfolio management regimen. Well, that's pretty much what they will do for any investment. And I think it's important. I think it's very important to keep this in mind, but I also think it's very important that this is evolving quickly. And I think particularly there are, in the foundation and endowment world, and of course high net worth individuals and everything, it's changing faster.
Saadia, your article called this the innovative finance revolution. Now, I know people in my business always complain about the headlines that editors put on their articles, but what makes
But you appreciated the headline, of course.
But let's accept the headline for the moment. What makes it, if innovative financing has been around for decades, what makes this a revolution? Is it the increased interest, the scale? Is that?
I think there are a number of things. I think we're at a point now where there are enough successes that show a path forward. Yeah. I think we weren't at that point when the Millennium Development Goals were announced 15 years ago or were approved 15 years ago. It started the focus and the interest in the area, and it gave us some successes, and we've built in those. And we've gotten to the point where, as Peter talked about it, we have catastrophe bonds that are done at a scale where the world of, the investment world notices. Green bonds have scaled, and Ken did the very first one when he was treasurer of the World Bank, that have scaled to a point where everybody knows what it is in the investment community. So I think it's the momentum that has built. I think it's also the fact that technology has gotten to a point where we have much more data available that allows us to build a lot of the solutions that
You couldn't have before.
that we couldn't have before. And in a lot of cases, it's about going in and testing and saying, take what I talked about earlier in terms of pandemics, right? Who would have thought you could think about an insurance product for pandemics, like whether it's Ebola or Zika or all the other dangers that are out there? But it's about going in and testing and saying, can we take this sector, can we take this problem and turn it into an investable proposition? And if so, what does that look like? We're at that point now where we weren't before.
So the increase is driven by momentum, it's driven by technology and data. To what extent do the four of you think it's also driven by changing public attitudes?
Definitely.
Yeah.
I mean, it's, you know, if, I don't know, we now live in this Google world where, you know, you can track this stuff. But there's no question that the press and the financial press has been very helpful. This is the every conference you go to, there will be something around ESG. There will be, you know, there's, I think our kids are the generation that sort of look at the world and go, what the hell have you handed me? Whereas
How'd you mess this up?
how did you mess this up so badly? And so I think that's it, this is the conversation around the dining room table, and I think that is part of the revolution. It's people are saying, okay, you bankers, do something, show us that you can do something good for the world.
Yeah, you all feeling the same thing?
And I think that's right. And in terms of technology, I think part of the reason why public attitude matters so much is we're in the day and age of social media, where everything's a lot more transparent and a lot more democratized, and therefore the breadth of the public opinion matters a lot, and the public cares about impact and societal issues. I think added to that is the millennial generation. And they're obviously coming to age, and in fact, if I remember the statistics, they actually stand to inherit over $30 trillion of assets. So they're going to be driving some of the decisions around how capital gets allocated. And as you know from the millennials, right, they care deeply about not just the financial aspect, but what they do with that money and what they do with their careers.
Do you find that true at Goldman? Or are younger employees much more interested in this end of the business than older ones?
Definitely. And you know, when we think about our environmental market platform, as well as what we do in terms of our corporate engagement and some of the social activity that we do, it's obviously first and foremost about good business, because that's the only way you can actually sustain it and make sure that we serve our clients, because we're fundamentally about a client service business. And obviously as a public company, we have to generate shareholder value. But we think about all the co-benefits. And our input is human capital. That's our real input. And so being able to attract and retain talent is incredibly important for us. And the millennial generation definitely care about what companies they work for and what impact are they having.
So you need this not just for the return, but for the talent, to satisfy the talent.
It's an important component of it.
Yeah. So, and what's limiting the growth? I'm going to open it up for questions in just a minute, but let's talk about what's keeping it from, as several of you have pointed out, there's no shortage of capital out there. So what's keeping it from growing even larger? Can you mention fiduciary standards that pension funds and others have to meet?
Yeah, I think that's an issue. But again, this is beginning to change. And as I mentioned, and as we've been discussing here, that as it becomes easier to quantify and demonstrate the longer term impact on investment returns, things of that kind, it's good. One other issue, and this is where I think the work that Saadia and her colleagues are doing is very important. A lot of what this takes, and I'm thinking about the securitization process. Take energy efficiency, for example. You've got, if you want to get an instrument that is going to attract that liquid, high-grade fixed income capital, which is the lowest cost, which will shorten the payback periods for this, you have to aggregate a lot of what can be small and idiosyncratic activities that are going on in lots of places. Well, that kind of heavy lifting is, in some respects, classic investment banking. But, you know, today, the compensation that comes from generating a conventional high-grade fixed income instrument for the people who do that work may not be what it was back in the day. And so to a certain extent, that heavy lifting is maybe not happening as quickly as it needs to. And so I think there's a lot of role for, there's a huge role for some of the public institutions, for Saadia and her colleagues to be fronting up the product development to get these test transactions teed up so that we can accelerate this entire process. So I think it's both the approach to asset allocation and everything on the investor side, but it's also the importance of getting these transactions.
What else out there is limiting the growth of innovative financing for social goals?
So I'm going to say something a little bit heretical here, but please hang. don't take it the wrong way, because as a Brit, we have the same problem. There's a tendency, one, to assume that dollars solve all the problems, and the truth is that there's a few countries where you can get dollars out of the cash point. I was recently in East Timor and was surprised to find how efficient that works, but not everywhere. Zimbabwe obviously counts as well. But in the main, there are local currency issues. So if you have a US pension fund and you say, I want you to deploy a lot of capital into green technologies in Africa, but where the green technology is generating local currency, you may not have brought the right things together. So currencies, the fact that the capital is not in the same currency, forget the fiduciary responsibility, but is not in the same currency as the places is a bit of an issue. The second challenge is that there's now this sort of sense that investment solves all the problems. And there are places where you do actually need a grant. Two clear ones. I mean, you sit here in the US, we talk about risk insurance, climate risk insurance in developing countries. But if you have a house in Florida, you will have weather insurance. That is heavily subsidized in the US. Agriculture in the UK or in the US, heavily subsidized. So we sort of applying investment models to some of these places where, in truth, the parallels in the developing world are heavily subsidized. And there's a lot of project which we're working on at the moment with the help of the Rockefeller Foundation around the Syrian refugee situation, where a lot of the press will tell you it's fine, the development banks are going to lend billions of dollars and that's going to solve all these problems. And you're looking at a situation and saying, no, it's not. This place needs grants in the same way that the sort of Europe got bailed out by the Marshall Plan all those years ago. Those weren't loans. I mean, we need.
Do you think we've gotten too excited about the potential of investment finance?
So, no, yes and no. In that I think that there's definitely a place for it, and we need more. But the challenge sometimes is this: that now I found this magic bullet, and you forget that it works as long as the rest of the architecture is there around it. It's not the sole solution.
Yep.
Can I just underscore the points that Edge made in a slightly different way, which is, I totally agree with you that before we can have innovative finance, we need to have the basic enabling environment for investment and finance to flow. And when you think about some of the least developed countries, you don't have even things like good governance, regulatory construct, the capacity, right, as well as the enabling policy and investment conditions or a functioning capital market for any investment to flow, let alone innovative finance to flow. So I think that's number one, fundamental. I think a second element, which you kind of alluded to, is that even though there are lots of innovations going on and scale to some of this, this is sort of finance 101, which is you need to have optimized risk return. And there are many, certainly environmental and societal interventions that have much higher risks or do not have any return at all that is tangible, right? And there are several different ways you can actually tackle this. One of the potentially most powerful ways, but also very challenging ways, is to try to internalize some of the externality. So if I think about the environmental space, there's many examples of what governments are trying to do, whether it's in the form of carbon pricing, to cap and trade mechanisms or tax, or even things like congestion pricing that tries to tackle traffic and environmental spillovers. So there's lots of different examples of that, but it's oftentimes politically difficult. Equitable distribution impacts are difficult, and competitiveness impacts are some of the barriers for actually having some of that done, right? And in the absence of that, public-private partnerships are really powerful, because well-designed public-private partnerships, whether it's in the form of grant, credit enhancements, or capacity building that DFIs do, enables you to leverage private capital that otherwise would not flow.
Yep. Let's open it up for questions. Start with this one right here, please, and identify yourself before your question, then we'll come up here and then over here.
Hi, thank you. Dan Zook with the Initiative for Smaller Finance. In the banking world, to do a transaction, right, we have the banker and then the investment, but there's also all this service infrastructure around that, right? The ratings agencies and the information portals, the merchant banks that help to facilitate that. What kinds of unique service infrastructure do you think we need, whether it's public or private, to do innovative finance better?
Who wants to take that on?
Somebody
jump in
I can
here.
take a stab at it, which is, you kind of mentioned it, right? I think you have to have a whole ecosystem of actors. When I think about green bonds as an example, which Kenneth's been really at the forefront of, right? Green bonds are great because it's a plain vanilla way of tapping into the fixed income market. The majority of the green bonds issued to date basically has leveraged the balance sheet and the entire credit of the issuer. So effectively the green bond versus a brown bond, for lack of a better way of saying things, has exactly the same credit profile, right? But we have to evolve that market, and we're seeing that happen to the project and the asset level of the underlying cash flow of the green, right? And in theory, although it hasn't been yet fully proven out, the green cash flows should be more resilient, certainly against continued constraints around carbon and policy and regulation, as well as, depending on what we're talking about, things like weather issues and physical risk as well. But you need the credit rating agencies to be able to see that and be able to rate that. You need investors to get more comfortable around the actual underlying project exposure versus the entire credit of the issuer. You need underwriters to be able to help facilitate that. So you need an entire ecosystem to be able to evolve the market in that direction. So I don't have one specific answer, but we all have to work in concert towards that.
There was a question right here in the third row, I think. Yes.
Hi, thank you so much for your comments this evening. My name is Neely Gilbert. I'm a co-founder and portfolio manager at Matarin Capital. I was wondering if we could come back to the issue of divestment, which you mentioned briefly, Kyung-Ah. How do you see divestment as a tool for impact? On the one hand, you'll hear some investors who have been involved in successful divestment campaigns like anti-apartheid or more recently coal, really champion it as a tool. But on the other hand, when you look at divestment, for example, from tobacco, this has arguably only enriched the remaining shareholders of tobacco companies when these companies are so cash flow generative that they've been able to buy back their shares at ever cheaper prices due to divestment. So when you think about negative screens and divestment, how would you unpack this as a tool for effective impact in public markets?
Who wants to do that? Ooh. Go ahead, Ken.
That's a tough one.
Yeah, you've identified, I think, exactly what these issues are. I think what I actually, and we did a look at this back in, I think, 2004 or so at the World Bank in the pension fund, and it was not a pretty picture, okay, that approach. However, I think part of the issue has been to get the information base, to get a much more extensive and disciplined approach to this kind of thing. That isn't going to solve the problem you've identified completely, because that sort of the tobacco example is very telling. But I do think that a great deal of discipline in the process is important, because one of the things that there was a long period where the negative list approach just kind of became the routine ESG solution. And I think that that leads to accidents of this kind, which then can actually undermine the credibility of the approach entirely when that probably isn't appropriate.
Yeah, and sorry.
Go ahead.
I was just going to say, I agree with Ken. And I also think it depends on what your ultimate goal is. And there's lots of different flavors for divestment strategies. It can be everything from outright divestment. And by the way, fossil-based stock is everything from coal to oil and gas to the actual value chain. So it depends on how you define that as well, in addition to the actual strategy itself. There's engagement strategies where you actually try to engage with the companies and hope to change their carbon portfolio and shift their carbon footprint. And there are passive strategies. We did one with the New York Common Retirement Fund, whereby we help them with a $2 billion low carbon index strategy that reshifts the entire portfolio so that, if I remember the numbers correctly, basically 70% of the overall carbon exposure is removed, but you minimize the tracking error against the broader market index. So there's lots of different flavors around depending on what your ultimate goal is.
Question right here, and then there are a couple of questions in the back.
Angel Fang from Opto Capital Group. I had a friend come from Shanghai, and they went to the New York subway and told me they thought they went to the coal mine. And Donald Trump proposed that we can print lots of money to fund the infrastructure. However, that will create massive inflation. So what's the innovative finance can do to modernize New York City? Thank you.
It's good, because we've sort of focused on developing countries, but obviously there are needs here in the U.S. as well.
Well, as somebody who visits New York or visits the U.S., I think you're right. There's definitely the need. The States has, like all places, has a massive infrastructure deficit and challenge there. I think there's a couple of things. One, people have got to be willing to pay for it and recognize that that's a public investment that benefits it all. And I think as a generation, we've lived off the investments of our Victorian ancestors to an extent. And in fact, when I think we look at countries like China, and the number of times I've joked with a taxi driver coming to Washington as we see that metro get inch by inch by inch closer to Dulles, but it hasn't yet reached Dulles. And I say to myself, in Shanghai, this might have been done a couple of years ago. You realize that's an issue. But I think it comes back to this point that as the capital is there and is willing to, or look, let me put it a different way. Everything has to change, okay? We are living in a world which has to decarbonize. That means that all of this infrastructure in our lifetime is going to have to fundamentally change, period. So I think it's an exciting opportunity to bring capital, to bring the solutions together to say, we're the generation that has no choice. We will have to change these things. And if we're going to build new ways of traveling around the cities, let's make them nice and let's make them fast.
Maybe I could just jump in with a comment as well. So I think the infrastructure gap, funding gap, exists practically everywhere in the world. And then you're right. I mean, there's a massive need for upgrade here in the US as well. One of the things that we've been working on with the International Finance Corporation, IFC, is around resilience infrastructure in the developing world. And it's to say, how do you create project preparation facilities that can identify these projects, that can help structure them in a way that they're going to be attractive to institutional investors. And I think innovative finance has a big role to play, and if it can be done in developing countries, it can be done here in the US as well.
So we have a problem here because we have lots of questions and very limited time. And so what I think I'll do is try and take a few of those questions in a row and then let you respond, and we'll start with the one all the way in the back. I'll get to you. Who else? That's two. There was one other right here somewhere. 3, 4. We'll take those 4 and then respond.
Okay, thanks. Back to that lady. I am from Shanghai. I'm a college student in New York right now, and I am working for a foreign exchange trading company right now. The foreign exchange trading market is the largest financial market in the world, with a daily trading volume of $5.5 trillion. So I just want to ask, is there any innovating stuff going on in the foreign exchange market? Thanks.
Good. Right there, yeah, this gentleman right here on the aisle. I'm sorry, I missed you further back. I'm going to take these four and we'll see if we have any time left.
Hello, my name is Kwame Marfo from the Heart of Africa Economic Empowerment Fund. We seek to provide alternative access to finance for SMEs in Africa. The question I have is the issue of unemployment and underemployment, which we consider to be the most acute problem facing most of Africa's growing economies. Africa has gone through a decade and a half of high economic growth, but in terms of job creation, the record has been fairly pitiful. Is this something that is registered on your register? And if so, what sorts of innovative financing schemes are you currently considering? Thank you.
Good question. Right here up front.
Hi, my name is Eunice Bettmansour. I'm with Actualized Consulting. So I'm curious about the liquidity of these bonds, of the green bonds and of the Gavi bonds. Clearly, investors who are purchasing these bonds, liquidity is important for them. And who makes these markets, especially with the shrinkage in the banks, market making activity and the desks and the prop desks. So how has that changed the liquidity since 2008? And how liquid are they? How liquid were they, and how liquid are they now? Thank you.
Good. And then there was a question right there. You see about 5 rows back. Yes.
Hello, I'm John Myers of MCE Social Capital, and I was wondering what exactly do you cite as like a situation about like the knowledge gap in terms of like inhibiting the growth for innovative finance? Like, say I'm a high net worth individual, and can I rely on like my financial advisor to be knowledgeable about innovative finance practices to align portfolios that I'm invested in with my ESG goals? And what is being done to kind of address this knowledge gap?
Good. Okay, so we have 4 issues that have come up: foreign exchange, what can this do about unemployment, liquidity, and the knowledge gap of finance professionals. I'm just going to, because we're short on time, I'm going to go right down the line, let you address any of those questions you want to address, but also make any quick final comments. Edge.
So I'll address the jobs issue. I mean, before I do, just to say on FX, know that FX is really the oil of the capital markets, and like any car, you want that oil to be running as smoothly as possible. So my view is try and make it as efficient as possible. And somebody who just had to buy dollars at 125 in the cash machine today, when spot's at 140, the more one can do to try to shrink that gap, the better. But coming back, I mean, jobs are important, and the key, I think, is that the last 15 years, if you really look at what happened and what changed, it was the private sector, and it was the growth of jobs. I would argue that by cutting government debt, which the governments did in 2000, that improved the FX position of a lot of these countries. And then, in truth, the biggest driver was the private sector. The mobile phone has probably created more jobs in developing countries than any other single thing. Electrification, in our view, would do more to create those jobs. And so many of the sort of the big industries, and that electrification, by the way, must be green, please. Many of those things that we're facing here, I think the indirect spillover will be the creation of jobs, and we agree with you.
Saadia.
So I'll touch upon the job creation one as well, but more from a small medium enterprise point of view, which I think the question came from as well. So yes, I think innovative finance has a role to play there as well. It is about making money available for these enterprises to start up to begin with and to grow. And in a lot of countries, they can be the backbone of the economy. One of the things that we funded, and it's something that's going to be launched soon, is called the Women's Livelihood Bond. And it is a securitized debt product that aggregates a portfolio of MFI loans as well as some social enterprises based in Asia into a bond that's then sold on to investors. And what it basically does is it makes money available to women that are starting their own businesses or run their own businesses and need the money. And the way it's structured is, again, it is a good investment for the investors, but it makes money available where money is very much needed as well. And there are applications similar to that you can imagine be, put in context in other developing countries, but different industries.
Yep. Ken?
Yeah, I guess the foreign exchange issue, I suppose I'm with Edge that we need to ensure that this is as fluid and real time as possible. I think it would help immensely if the Chinese effort to free its capital controls and all of that were to continue, and we would see a free flow in and out because it's one of the larger economies in the world, and it would be nice to see that happen. I think on the on the liquidity, I think the jury is going to end up being out on this, because I recall prior to the end of Glass-Steagall, we had actually quite liquid markets, and I think it's going to be interesting to see how this plays out. I don't know the answer yet. I think, from what I understand from my former colleagues, as between the green bonds and the brown bonds, we're not seeing material differences in the bid-offer spread for a given size. But I think the impacts of the banking regulation, we don't know. I don't think we know yet. The conventional wisdom is liquidity is falling.
Yeah. Just on the liquidity point, separate from the broader market issue, on green bonds specifically, again, it's still early part of the market, so it's hard to have expansive information. But they tend to be less traded in the secondary market, in part because investors actually want to hold on to the green bonds, and there isn't enough of a supply as of yet relative to the demand. So that's point number one. Point number two, on the small business point, let me just supplement a couple of examples, because job creation is actually a very big challenge, not only in Africa, but in the rest of the world and also in developed countries. And there are lots of different ways you can tackle it. In fact, the green bond framework has been applied to social bonds. We issued a bond for a state-run Spanish bank called ICO that specifically raised €1 billion that actually funds small, medium enterprises in the underserved markets in Spain to create jobs and retain jobs. And then we have a program called 10,000 Women, which actually is about training the women and enabling them and equipping them to be able to become entrepreneurs. And we have a partnership with the IFC that effectively is helping to deploy $600 million globally to help fund women-run businesses, which is another way of helping to catalyze jobs. And then briefly on the question around ESG and education and raising awareness, we still have a lot of work to do. But the good news is that I think almost all asset managers that are large and are serving clients, mainstream clients, have some sort of an ESG integration strategy and are developing products, a suite of products that hopefully you can actually start thinking about how you want to allocate your assets around. And part of it is understanding your goals, right? Because everybody that says they want to do it have different objectives, and defining those objectives I think are very important.
Great, thank you. Apologies that we didn't get to all the questions. Thank you to Foreign Affairs for pulling this panel together, and thanks to the great panel.
Thank you.